So around the margins, there's some. You always, basically like, U.S. shale oil. There's actually a recent survey that they do them quarterly throughout Texas, for example, to see what the plans are of energy capex. And there's really nothing remarkable, right? I mean, basically, everyone's saying, okay, inflation's transitory. We're not going to chase this. We're not going to, radically increase our energy production. And then, you have policies like windfall taxes in parts of the world and things like that, where they say, well, I mean, if we don't even have good clarity on what percentage of our profits we get to keep from this, maybe we should just hold off for now and not invest. And so I think, partially private sector decisions and then partially, public policy implications contribute to pretty low, new investment. So it's certainly looks like it's going to be higher than this year, but not way higher. And that's compounded by the fact that a big percentage of that amount that's going to be higher is inflation. So the actual, when you factor out and say, okay, how many actual barrels are we going to get online, to offset our declining existing wells? I think the answer is not much. I mean, we've already seen kind of a flat line in U.S. shale rebounding. So we still have not hit our high water mark in terms of U.S. Oil output, kind of the pre-COVID level. I think there's a good chance we will eventually get to that level. But, the initial several months of, say, 2021 and things like that, we were rapidly going back up in terms of oil production. And now we're kind of like rolling over and flatlining because the marginal barrel is always that much harder. And, for example, analyst Luke Groban would describe it as peak cheap oil, which is that there are plenty of oil and gas sources still out there throughout the world, but that we already have a lot of the low-hanging fruit. And so we're turning towards things like, shale that, for example, rapidly depletes. You have to keep heavily investing in it in order to just maintain the output, let alone grow the output. And then you have other unconventional oil sources that on average can be somewhat more expensive. And then you have, some of the cheapest sources of oil, like a lot of the Middle Eastern oil, for example, that's not really growing anymore. And so I think that's kind of the tricky environment, that you need quite a lot of capex in order to get an amount of oil that is not much higher. I think we've seen changes in the narrative, right? So we've seen a rapid shift in desires to shut down existing plants. That's been pretty quick. Japan's also accelerated their reopening of some of their reactors that they've closed since Fukushima. And so around the margins, you have seen that. We also, China's building nuclear reactors, India's building nuclear reactors, some Middle Eastern countries are building nuclear reactors. But as you point out, those take quite a while. Now, the funny thing is, you look back in the 70s, those were built pretty quickly. Part of why they take a long time now is regulations and things like that. Obviously, you don't want like a Chernobyl 2.0. Part of why that was so bad is because it didn't even have the dome, the concealment dome around it. And so obviously you don't want unscrupulous like nuclear builders. But we've kind of hit this point where it's like choked off by, it's almost impossible. Like in the United States, it's almost impossible to build a new nuclear reactor. It's just it's not a business you want to get into. And so part of that's kind of our own doing that it takes so long. It doesn't fundamentally take that long. It takes longer than a coal plant, but it's not like there's no law that of nature that says a nuclear plant has to take 6-7 years to build. And so it's partially our own doing, and just kind of the state of kind of the global construction industry, especially in developed markets. Things take longer. It takes us longer to build a skyscraper now than it did the Empire State Building in the 1930s. So I think it's been somewhat surprising how resilient so far the economy's been to recession, but I still think the picture does not look very good for 2023. It depends on a few different variables. So right now, for example, the U.S. yield curve is inverted, which means that the 10-year treasury is a lower yield than the 3-month treasury. The last 8 recessions, the yield curve inverted before the recession, and there's been no false signals, right? So it's never inverted and then there's no recession. Now, the caveat though is that sometimes it's a recession happens 2 months later, and sometimes it happens 2 years later. So there's a pretty wide gap for how long it can take for a recession to materialize, number one. And another challenge is that monetary policy happens on a lag, because especially in the United States and in a number of other countries, a lot of the debt is fixed rate. And so, just because mortgage rates, for example, shot up dramatically does not mean that the average American homeowner is paying a higher mortgage rate. Basically means that fewer mortgages get taken out at those higher rates. Fewer people ever want to leave or sell their current home. They want to lock in and keep their current mortgage rate. And so basically a lot of those are unaffected by the increase in rates. And so what happens is quarter after quarter, potentially year after year, as rates are at a higher level, some percentage of debt matures and gets rolled over. Like some corporate debt matures and gets, refinanced at these higher rates. Some people just have to move. Things happen, and then so low interest rate debt gets refinanced at higher rates, and that eats into incomes. It eats into things that they otherwise could spend money on. More of it goes to bondholders, banks, things like that, and away from the non-financial industry. And that can contribute to recessionary conditions, especially because if you look at, office, like commercial properties, they've never recovered yet from the combination of COVID and remote work, right? So it's not that, remote work was always going to happen to some degree. And what COVID did was say, okay, we're going to take the next 5 years of remote work and push it into 3 months. That kind of trend was rapidly accelerated. And so even as it bounces back somewhat, a lot of companies have already decided that they need less office space than they used to. And so there's higher, vacancy rates, for example, in New York office real estate. I'm sure many other cities as well, including, cities throughout Europe, cities in other countries. And so over time, as those holders of those properties have to refinance their debt at higher rates, that just puts pressure on them. And so I think that it's one of those things where we're kind of in a more stagnant environment right now, and we'll see if it descends into an outright recession. So right now, U.S. unemployment, for example, looks like it's bottoming and maybe turning up a little bit. You see consumer confidence, CEO confidence, measures like that are very low. The one saving grace that is somewhat, I think, keeping things afloat is that if you look at this year, the dollar index was soaring, which, again, to my prior point earlier in this discussion, puts a lot of pressure on the entire world. But in the second half of the year, you've had like a rollover in the dollar index. It's kind of left off some pressure. And so that's been a constructive environment for a lot of developing countries, a lot of just indebted entities around the world, and it's given them a little bit of like a breath of life. And combined with the China's reopening, that's kind of the one variable to keep watching to say, okay, the U.S. is kind of, in some ways, purposely putting itself into a recession to try to regain control of inflation. But then the question is, as the market, looks at their inverted yield curve and maybe stops, paying more for the dollar, it allows these other indebted entities around the world to potentially stabilize and start doing okay. So I'm perhaps less bearish on the rest of the world than the average person is, but I still think that 2023 does have a lot of risks for recession or near recession, just overall kind of weak economic growth.